Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me today is Manish Khatta of Potomac. And we're going to talk about tactical allocations and how advisors can use them in their practice. Manish, this is your first time on the Resilient Advisor Show. I know that you have a large footprint on social media and social media fans. Why don't you introduce yourself to my audience?
Absolutely. My name is Manish Khatta. I am the president and CIO of Potomac Fund Management. We are a third-party investment strategist as well as running a UMA TAMP platform for financial advisors.
Excellent. And Manish is one of the most informative and entertaining presence on social media. I encourage you, if you're on Twitter, make sure you follow him. His symbol is simply @ and his name. Always hard to get unless you have a unique name, isn't it?
Yeah, for sure. No one can get that one.
I noticed in your bio, you grew up in Maryland and you've moved down to Florida. I bet that's been the best trade of your career so far.
Yeah, you would be surprised because weather-wise, of course, it's awesome down here. But I'm born and raised in Maryland, and as I have 4 young kids now, I do miss that's home, and I miss being around my folks. So we're here, but we're actually looking to possibly to move back.
Really?
Yeah, I have 4 kids under 4, and there's no family here, and that becomes burdensome after a while for sure.
It most definitely does. I actually can relate to that. Don't move back in the winter, though. You want to keep your family together.
Yeah.
All right, so let's talk about tactical portfolios. So Manish, my audience, almost 100% financial advisors. If you're watching and you're not a financial advisor or serving them, this is really just going to be all gibberish to you. When you work with financial advisors and you're having the conversation about tactical portfolios, how do you approach the idea of adding it to their model portfolio allocation?
I think the worst thing that happens in my experience when financial advisors approach models is performance chasing. And what happens is you run a screen and you say, all right, these are the top 10 models. Let's just start, allocating to them. I think you really have to take a step back and figure out the risk situation that your clients want to be in and then allocate across different models. I've always said you have to diversify your trading strategies, not diversify your asset classes. So what that means is you can have a tactical model with a passive, maybe some alternatives, and that's where the combination makes the most sense. You should never be 100% tactical, and that's obviously going against my belief in terms of how we manage money. But I think for the expectations of a client, you should never overload on one or the other.
Yeah, and that's actually a different language than I hear from other tactical model providers. They tend to preach you need to only do tactical. And what I've learned from boots on the ground application with advisors, not only can that lead to bad outcomes, it really becomes a challenge managing client expectations when the models aren't working. And it sounds like what you're talking about is diversifying your diversifiers. Could you give some real world applications on how your firm helps advisors implement tactical models into their strategies?
Yeah, one of the things that's really been growing recently is our OCIO program. And it's not actually really a program. We're just helping advisors navigate their TAMPs. And what's interesting is the last 5 advisors we've spoken with about this, they're not even clients of ours. They're just reaching out to us saying, hey, how do we put together these models, even on my own TAMP platform through my broker-dealer or whatnot, because there's no education around how to actually construct these models so you don't have the same models doing the same thing. For example, we had an advisor the other day that sent us a model, and he loved the performance of these 3 managers. But even though the names were slightly different, they were all tactical high-yield models. And we said, look, you can't just go on the quant side of this because they're going to do the same things in the same markets. And you have to really make sure that you have complementary models. So, we're always telling people, listen, approach tactical on the risk spectrum. So as your client ages maybe and needs to take less risk, I would increase tactical. But when they're younger and in the growth mode, frankly, you're probably better off not allocating as much to tactical because of the possibility of underperformance in a really strong up market.
Manish, let's go a little deeper on your OCIO services. OCIO means different things to different people. If you're an independent financial advisor today and you're looking to find OCIO services, what does that look like if they reach out to you guys?
Well, with us, it's you're right. It means different things for many people. For us, our focus on model portfolios. That's who we are, and that's our expertise. So for us, OCIO means if you're on a TAMP out there and you have access to model portfolios, we'll help you put those together and come up with the optimal combination. That we're not going to actually, build individual securities into that model. We're taking all the different money managers that are out there and using our knowledge to combine those for advisors.
Excellent. So because I like to invite guests on my show that have names that are difficult for me to pronounce, about 2 months ago, I had Elisabetta Brachelio, who's a PhD academic from Italy, and we did a long form podcast where her and her partner have put out some great academic research around diversifiers. And what they found is that if you look at low volatility, you look at trend following, and then you look at risk parity as 3 ways to put those diversifiers into a portfolio and then manage those to a certain percentage allocation, you can have some better outcomes. What are your thoughts on all 3 of those potential diversifier strategies? And a follow-up question is, should you use all 3 of those at the same time?
Yeah, I don't like the concept of buying and holding anything personally. So to me, I've seen this stuff where they say, listen, put 20% in this diversifier and just have that be an allocation. I don't think that makes any sense, because frankly, from an experience point of view, the last 10 years, for example, that 20% has just been a thorn in your side. It's underperformed greatly. And in all likelihood, it probably didn't even perform well on this past decline with the pandemic bear market, because of the fact that trend following, which a lot of times is the underpinning of some of these diversifiers, the bear market happened too fast. And so, I just don't think you should ever buy and hold any asset class. You want to be invested in them when the time is right and when they're coming up the screens in terms of momentum. So yeah, my take on diversifiers is use them, but never just hold them blindly.
Yeah, and I think the crux of her work, and I hate speaking for a PhD academic, was to diversify your diversifiers inside of a portfolio. So let me turn that question around. When you're building out tactical models and they have different diversification strategies, are you swapping in and out the diversification strategies, or do you diversify them and hold the different diversification strategies?
It just depends on the market you're in. This is not something where you can lay out a plan and execute it, to perfection. It just depends on the market you're in. If you're in a longer-term bear market, and let's say a lot of your indicators are negative, there's probably some value holding certain diversifiers like a managed futures or something like that. But if your indicators are positive, you should stay away from those. I mean, I posted on social the other day, you look at AQR, the smartest PhDs in the investing world. Their managed futures fund, the 10-year performance is 2%. It doesn't. You got to hold the right investments at the right time. And so it really depends on from a tactical point of view, what's your outlook on the market? What's the current situation in the landscape you're in, and then make that decision if you want to add any of those alternative diversifiers. 9 times out of 10, they're useless and don't work personally, but there's a small piece where they might be helpful.
Okay. So let's make sure that I might be barking down the wrong tree when you talk about tactical portfolios. And I was assuming these were portfolios that had those types of diversification strategies in there. So let's take a step back, and I probably should have started with this. Define what a tactical strategy looks like at your firm.
Correct. That's probably a better place to start. For us, we believe that, you should never buy and hold any asset class. Being tactical means you are moving into certain asset classes based on momentum. So if you're positive on the market from an indicator standpoint, and what I mean by that is we have quant indicators that we run that gives us an outlook on where we are in the market. Are we positive on the current market trends? Do we want to be fully invested? If that answer is yes, then you want to ride momentum. Right now, for example, you want to be in small caps and international, And that's what you want to overload your portfolio in. So to us, a tactical model that's even moderate or conservative can be 100% invested in all equities. It matters more about what's going on in the current market landscape than it matters about buying and holding asset classes.
Excellent. So Manish, what are the current indicators that you're paying the most attention to in your models?
Well, so a lot of ours systems follow market internals, market breadth, advanced decline, new highs, new lows, volume, things like that. That drives a lot of what we do from an indicator standpoint. And frankly, they're all pointing to a bullish trend that remains and continues. So based on those, there's some other things as well, but that's the main driving force. We're still positive on the outlook here.
Excellent. And for your offering to advisors, I know you mentioned earlier there's not a lot of advisor education. When people contract with you guys, what type of advisor education materials do you guys make available to your clients?
So we take the standpoint of being the chef model, right? I always talk about this where celebrity chefs write cookbooks, but also have restaurants. The reason being, they know you're not going to take that cookbook and go make their meal exactly. And so we take the same approach. We show everyone our systems. We show everyone the indicators. We do a lot of videos, obviously, that are on YouTube and internally. And we open the book. And we're anti-PowerPoint, guarded presentation material. We want to show advisors exactly how our systems work, how we pick ETFs, and give them that comfort level that there's a quant process behind what we do.
Awesome. You're anti-PowerPoint. I love it. I bet you've used that line a lot.
Yeah, listen, I've been in this industry. I've seen enough pitches where someone sits down and tries to explain what they do in a PowerPoint, and 10 minutes into it, you have no idea what they're talking about. Right. Advisors don't want to be talked down to, they want to be talked to. And that's the major point that we try to emphasize with our marketing and education.
As an aside, I noticed on Twitter you guys are hiring, and in your post you said you're allergic to CFAs. That's awesome. I'm going to steal that if you don't mind.
Yeah, no, I mean, it's true. Like, listen, I once again, like, why would you take something so pure and truthful like price and ruin it with something so distorted like earnings? And so, the CFAs of the world, I'm sorry, no harm, no foul. We can hang out one day. But in terms of what we do from a money management point of view, security analysis is an absolute waste of time.
I love it. I've had a lot of folks with that philosophy and opinion on the show, and I have gravitated towards that. I'll tell you, Manish, so I'm in my late 40s. I, went through the regular Series 7 programs as a kid in my 20s. Got an MBA from Emory, CFP SEMA. All I'm taught was valuation. And boy, I could not have spent more time in my career taking the wrong approach to investments. So I'm with you. And I've actually started a quantitative series here on the show where we've interviewed folks like Wesley Gray and, Corey Hoffstein, and they came on and they walked through their process, and it's very, very enlightening and helpful to advisors who, like me, Gen X and older, have been stuck in the valuation mindset. So if you're watching us live, feel free to ask questions by simply typing comments on Twitter, LinkedIn, YouTube, or Facebook. And Manish, I've got your website up now for people who are watching this on video. Walk us through what you guys offer at Potomac.
So we have strategies that are available on different TAMP platforms out there. So direct with us, we have our own internal TAMP platform that we offer to advisors. That's one silo of the business where we offer other strategies in addition to Potomac, because like I said earlier, you should never allocate everything to one style. And then our strategies are available on major TAMPs like InvestNet and SmartX, et cetera. So, advisors can access us in many different areas in terms of, if they're an RIA or with a broker dealer.
So I've heard a lot of great things about SmartX in the last 4 months. And I can tell you, a year and a half ago, that wasn't the case, I think, as they were building it out. But I've heard that the technology is second to none, especially if you're an advisor custodying at Schwab. What's your experience been like with advisors using the SmartX platform today?
So SmartX is a lot more sophisticated than the other TAMP platforms. What advisors don't realize is when you use a strategist on an old legacy kind of technology platform, there's no intraday trading. That strategist can execute a trade once a day, and that's it, right? The way SmartX built their platform was, allow managers to do intraday trading, and it allows for a lot more strategies than you would a traditional TAMP. So yes, their technology I think is much better. I think from a management point of view, you're going to have access to a lot more sophisticated strategies, and that could be good or bad, right? It just depends. And so, like one of our most popular strategies screens very well on most platforms. Then you go to SmartX and we're on like page 4. Because they have so many other strategies there. So yeah, I'm big fans of Evan and the crew and the work they're doing down there, and they're right north of me, so they're friends of the firm.
Excellent. And what other TAMPs are you on for viewers and listeners?
The major one is InvestNet. So a lot of the broker dealers that have the custom version of InvestNet were available there, and as well as SmartX are the main ones. But we're getting added to a ton. We have about 40 in the pipeline, and so a big part of our business is to make sure that we're on as many platforms as possible for advisors to use.
Yeah, makes sense. Tell us a little bit about the Union UMA.
So other TAMPs are frenemies. And the reason I say that is because our models are there and we support their business. But the feedback we got last year was that there's no help. You go to these large TAMPs and no one is helping advisors create portfolios. And also as these TAMPs scale and get bigger, we've heard a lot of complaints about service. And so as any good business owner, when you hear complaints and feedback, it's an opportunity. So this past June, we launched our own TAMP where advisors can come to us, and we're targeting smaller advisors, 100 million and yet less, can come to us with their whole book of business, access multiple managers, and we'll help them put together these model combinations. And we'll do all the billing, reporting, technology, and be their back office. And so we wanted to make our own offering to smaller advisors to help with close that feedback loop that we were getting on bad service and no model help.
There's definitely a void in that space. So how has the launch gone so far?
It's gone, better than we could have ever expected. We launched it it was, I think, July 1st to end of June. Pandemic, everyone's at home. And we thought to ourselves, that hopefully this works, right? Anytime you do a product rollout, you kind of don't know what the outcome is going to be. We've essentially doubled our AUM, AUA in 7 months. It's really, we have a wait list about 6 advisors deep. It's really taken on because I think that frustration level is only getting worse with more and more scale and more private equity entering the landscape. So we're really honing in on that Ritz-Carlton experience for smaller advisors.
How could advisors find out more about that offering?
So it's not hard to find out about us, right? We're everywhere on social and on YouTube. If you go to our website, there's a tab for Union. You can fill out a form, get added to the wait list, and we'll reach out to walk you through the platform and talk about how we can help.
Excellent. And the last question revolves around your podcast. As a fellow podcaster, I know how difficult they are to produce, how much fun they could be to produce. Tell listeners about your show and what your experience has been so far producing it.
Yeah, I probably try to quit every Monday, and it's been a struggle. Look, we said let's just record our conversations between my business partner and myself, and let's just do that. Let's start there. And I'm a big Gary Vee fan, so I believe in recording everything as your content. And it's, I tell everyone when it comes to marketing, put your head down and wait 2 years because you're going to be frustrated. You're going to wonder why no one's watching, why no one's listening. And a curious thing happened recently. All of our YouTube, we record for audio and video and post on YouTube. The views were about 3, 5, 10 views. This is 2 years worth of podcasts. And all of a sudden, 3 weeks ago, they go to 500, to 800, to 1,500. The point being is you gotta put out that spider web of content, and it will eventually work. The problem is people quit. You know that, right? The average podcast is 7 episodes. There's a reason for that because it's hard, and you want to give up, but you shouldn't. It's been one of the best things we've done from a marketing standpoint.
Yeah, I jumped on your YouTube site to see what you guys had done before this interview, and it is impressive. And it is the model. It's what I've experienced. You grind and you grind and you grind, and there's a J curve effect to it that once it hits, it creates a life of its own, and it looks like you guys are there. What could listeners and viewers find on the Conquer Risk podcast and show?
So we've created multiple channels. One is me and my business partner just talking about the ins and outs of running an RIA. We all go through similar struggles when it comes to running a business, and we want to share those conversations. And then we created two different channels, one being industry gossip, where I'm going to say if things are overrated or underrated based on news that's hitting our industry. And the other channel we're doing is build in public, where the concept is all of our marketing, we're going to record the meetings we have about campaigns we're running and launching, and we're going to build out our marketing in public so people can have a full transparency, and maybe they can take some information from that in terms of advisors and their own marketing. And those are the couple channels that we're going to release. But the concept for everything we do is really transparency and building in public.
Excellent. I'm looking forward to see those shows grow here over the next year. I appreciate you coming on the Resilient Advisors Show and all the work you're doing for financial advisors on social media. Thanks for coming on.
Thank you, sir. I appreciate it.